Hello, everybody. My name is Warren Ackerman, head of the European Consumer Staples team at Barclays. Welcome to the Global Consumer Conference. I'm delighted to have Alan Jobe, Unilever's CEO, with us for the session today. The format's going to be a fireside chat. We have about 30 minutes. So, Alan, thank you for joining.
Thank you, Warren. It's a pleasure to be here.
A lot to ask you in a short period of time, but why don't we crack on? And just as an opening question, I'd love to kind of hear your perspective. Almost 2 years in as CEO, lots of highs and lows, interspersed with COVID. Could you maybe just share with us your learnings in that period and any regrets that you've had as CEO? What's been the high points? What's been the low points?
Yeah, thanks, Warren. Well, it certainly has been a busy 20 months. Last year, more or less in the first quarter, we put a completely new leadership team in place. 3 people from the outside, promoted 3 internally, rotated 3 and 4, stayed in continuity roles. Second quarter, we worked on a new expression of our company strategy. Third quarter, we really started to dig into our operational capability. Were we executing to our full potential? And in the fourth quarter, we really embarked on a bit of a deeper portfolio review. Since then, of course, we've now got this very challenging crisis mode that we're in, where we've got a health crisis, social crisis, people living and consuming differently. We think we're on the brink of a bit of an economic crisis, racial justice crisis, climate crisis. So we've been a bit in crisis management mode for the last 6 months. And I think what we found is Unilever is quite resilient. We've attacked new levels of agility that I don't think we knew the business was capable of. And we've tried to keep going with the strategic changes, things like pushing through Unification, making a move on tea, and some big sustainability commitments that we might get into. You know, you asked me this devious question about regrets. Probably the thing I would say there is that I think we could have moved about a quarter faster on really digging into our operational capability, the intensity of our execution, and having identified these rather simple 5 growth fundamentals. I think they have been an unlock for us, and I wish we'd got onto that maybe a quarter or so faster.
Okay. And just maybe moving to competitiveness, it's been a theme in the last few quarters. It does seem like your competitiveness is improving, execution has stepped up somewhat. Can you maybe talk to us a little bit about what's driving that? You know, you've got a new COO of knitting, looking at cell methodology. Is that been part of the driver, or has it been more holistic across the board?
Well, let me just start by saying that it is an absolute priority for the company to close any gap between the potential growth of our portfolio and the realized growth.
Yeah.
And you're right, the foundations for better execution were laid last year when we recreated the Chief Operating Officer position that Nitin sits in. We introduced a flatter organization. It goes straight from Nitin to 15 big markets. And that's really become our mechanism for managing performance and landing our global initiatives. Our 5 growth fundamentals have really brought focus in our markets organization on what moves the needle to get better growth. And what we've seen through COVID is the speed that we've needed has actually come from this simpler markets organization. We've gone from Unilever's executive meeting on a monthly basis to meeting on a daily basis. And I think the elapsed time between deciding we want to do something and it's starting to happen in the market is now hours, not weeks. Our GMs are highly empowered to make decisions on the ground. And, you know, it is showing up, you're right. We can see penetration levels of our brands stepping up and a sequential improvement before and during coronavirus in our volume-led market share. Now what we're preoccupied with is how do we lock in this new found speed and agility in a kind of new normal.
Okay. And you touched on COVID. I mean, clearly demand patterns have been turned upside down. Just interesting to hear your take on which of those do you think is transitory, you know, which is permanent, what's going to be enduring for Unilever through this?
Well, look, we're well beyond any of those very short-term things like pantry stocking. And so we think there are things that have got medium duration and things that will be more or less permanent. So the medium duration things would be the extraordinary growth we're seeing in hygiene categories. So hand hygiene, surface hygiene, that'll run for a while, but it won't, we won't see the types of growth that we're seeing there indefinitely. But the other big one is in-home food consumption. I think we were a little slow to realize just how important a shift that was going to be on the downside from out-of-home eating in our restaurant business, supply business, food solutions, and on the upside in our in-home foods business. Then, the more permanent effects that we're anticipating are everything. So, how we browse, how we buy, how we pay, the media we consume. We think that's a one-time change. It's a ratchet up. Similarly for e-commerce, we saw this in China back in 2010 when they had pandemics out there. The step up in e-commerce stayed. The second area that I think is semi-permanent is the preoccupation with health and well-being. So anything to do with immunity, health, well-being, we're seeing a big surge in our small but beautiful vitamins business. In Horlicks, where we've actually moved quickly to introduce some new products around immunity. And even those kind of health and well-being bits of our prestige beauty portfolio, we're really seeing a step up there.
Okay.
And the third area that we think is going to be semi-permanent is conscious consumption. We are seeing that sustainability issues are mattering to consumers even more than before coronavirus. I think they feel, particularly young people, that it's time for business and brands to show more responsibility on their social and environmental footprint. If you're interested, I can go into some research that's been going on around that. But that's the third. And then, of course, what we don't really know is how permanent the recession-driven behavior is going to be.
I mean, on that point on recession, I mean, we can't get away from how deep the recession is. How well positioned would you say Unilever is? How much down trading are you seeing? What steps are you taking to ensure the resilience of the portfolio in that downturn?
So I think we believe a global economic downturn is absolutely inevitable, but we don't know the depth. We don't know how it will play out by country. But we do know some things from the past, which is that in recessions, consumers are looking for value, and that does not just mean lowest possible price. Yeah. So we see typically a tilt back to big brands because of the trust that they bring. We see value channels, that would be the discounter channels in Europe or the dollar stores in North America, or cash and carries in Latin America typically do well. And of course, value brands and value pack sizes benefit from smart shopping. Interestingly, the role of price, value, and affordability changes country to country. So in South Africa, for example, where group buying is a common behavior, big pack sizes take off in recessions. In other markets, small pack sizes. We don't compete by slashing prices. Our value portfolio, call it products at below about an 80 price index, makes up 20% of our business. Given that many branded players don't play at all in the value tier, it's quite a good start. And right now we've got squads working on where have we got gaps in our portfolio, market by market, brand by brand, pack size by pack size. In general, our value portfolio has a different P&L profile. So what we would expect to see is some gross margin erosion potentially, but not an erosion of operating margin, because these brands typically demand less in terms of marketing support. Okay.
And just shifting gear, Alan, to channel and e-commerce. I mean, clearly e-commerce is booming. I saw that e-commerce in your US business has almost doubled H1 on H1, and you're doing very well in terms of market share. Can you just talk a bit about the resources you're putting into e-commerce? Can you do it in a margin accretive fashion? Where are we in terms of the journey and the investment in e-com?
I think this is the right area to spend some time on. First thing I should say is we have a bit of a mixed picture on our online shares versus our offline shares. It's by far not homogenous that we always have a higher online share than offline share, so there's no complacency there. E-commerce represents 8% of our portfolio in the first half. That's really a function of the categories, brands, and geographies that we're in. It's growing very, very quickly. I could easily see a day when e-commerce represents 30% of Unilever's business.
Yeah.
From a margin perspective, it's accretive, broadly driven by the mix impact. So we're not worried about the growth of e-commerce. It's important to really start moving away from one grouping, because pure play dynamics are very different from omni-channel dynamics, very different from direct to consumer. And maybe the most strategically important part of this for us might be business to business e-commerce, which is already very significant scale and growing very quickly.
Okay. And maybe just turning to the US, because that was another feature of the results. You've struggled in the US over recent years to get the growth that you want, but you grew 9% in the second quarter, if I remember rightly. You got new leadership in the US. So Fabian Garcia has taken over from Amanda Suri. Just interested in, that growth. How sustainable is it? What has the new leadership team brought to the party for your business there?
Well, without saying too much, we are seeing sustained strength in North America and the US particularly. Of course, there was some crazy stocking up in March, but since then, consumption patterns do seem to have settled at higher levels of demand. Yeah. It's especially driven by hygiene products and in-home food. We saw very strong growth in foods and refreshment. I think it was up 23% in Q2 when you strip out our out-of-home food business. We're getting a little bit of topspin from the stepped up competitiveness in things like hair care and dressings. E-commerce has been a big driver. We think we're got about 2/3 of our business is winning share online in the US. Yeah. And Fabian's been a big addition. Frankly, I think we've attracted a great leader for the role. In many ways, he's a bit overqualified for the job. He's served as a CEO before. Yeah. He was very explicit about being attracted by Unilever's purpose and our values. Fabian's bringing a high level of operational intensity. He's particularly strong on making prioritization calls. And he has led brilliantly through the social volatility that we're seeing in the US. So I think a really great add to the team there.
And just in terms of emerging markets, Alan, 60% of sales or just under, you've got 4 big ones that really matter: Brazil, China, India, Indonesia. Everybody's worried about the macro top down in EM. But can you talk about your resilience kind of bottom up, in terms of the affordability, the channels that you're looking at, the B2B channels? I'd love to hear how you've dealt with crises in the past and what learnings you can bring this time around.
Well, the way you ask the correct question is the correct one, because emerging markets is not a helpful aggregation anymore. We never use it in the company other than at results time. Yeah. We do need to decompose a bit. Yeah. We don't have time for an entire world tour, but let me hit the highlights. First thing to remember is that 85% of our business in emerging markets comes from positions where we've got either the number 1 or number 2 brand. Let's start with China. China's been quite an important leading indicator for other markets to learn from. Channel shifts, how you go back to an office. Yeah. And we saw growth in China bounce back very quickly. It was 6% in Q2. Yeah. We're a Chinese company in China. 97% of our managers are Chinese. We've been the top FMCG employer of choice in China for the last 3 years. We have very strong partnerships with Ali and JD. And we've got an unusual distribution model where we've now figured out how to get into the lower tier cities. We call it DTX. And there's faster growth coming from those smaller cities. And so we're quite happy about that. Okay. I won't say too much about India. Everyone knows our position there. Other than to say that the market is definitely down, but 85% of our business there is winning market share. Yeah. And so the speed and agility of Hindustan Unilever means that when things bounce back, we do expect to do well. The Horlicks acquisition is going exceptionally well. But the disease progression is a worry. It's the only major country where we're still seeing exponential growth in cases. At the moment, the 7-day rolling average is about 70,000 new cases being diagnosed a day, although the cases per million is still half the US. So we're a little bit in watch and see mode in India. I think Southeast Asia will bounce back quickly. We're seeing Indonesia coming back. We know very well how to manage through crises in Southeast Asia. Perhaps the exception is Thailand, which seems to be hit very hard by the tourism slump. Now, Brazil is the most interesting one, I think. Again, a position where we have very strong positions. I think, if I'm honest, I'm a little surprised that the business there continues to grow. We've landed pricing in that market very well. We've built, I think one of the features is we built up a strong B2B e-commerce business. If any, you'll get the gist of it immediately if you just go Google Compra Agora. And if there's one market that knows how to manage a crisis, it's our Brazilian team. But we do think that economically LATAM is in a bit of trouble and will take longer to recover.
And just shifting gear again to margins, you've obviously kind of stepped back a bit from the 20% target. You've always said margin is an output, not an input, and I totally get that. But looking at the model going forward, do you expect to still be able to sustain the 2 billion euros of annual savings that you've enjoyed over recent years? And, you know, I don't want to try and pin you down on a specific number, but I mean, even if it's like 19%, is it going to be like a flat margin from here, or can we expect to see some modest improvement, or is it all about getting that top line to pick up on a flattish margin?
Look, I think the answer is yes, yes, and yes.
Okay.
Yes, we can continue to deliver the savings. Yes, the absolute priority is top line. And yes, we can expect some sort of margin evolution. Let me just explain why a little bit. So our absolute focus is competitive, volume-led growth. We know that brands that gain volume share during recessions typically grow 1.4 times faster than the rest of the market for the next 5 years. That's why we're so obsessed with penetration, and we're seeing the improvement. If we decompose our business into its relevant segments and compare the profitability of beauty and personal care with its relevant set, home care with its relevant set, and foods and refreshment with its relevant set, what you see is that foods and refreshment and beauty and personal care are kind of middle of the pack. Home care, although it's improved a lot, is still actually towards the bottom of the pack. And so looking at our aggregate margin, and also when you decompose it, we do see some headroom for continued margin evolution, but for the 500th time, it will never be at the expense of competitive growth. And maybe lifting the carpet a little bit, I don't think it'll be at the same rate that we've seen in the last 4 years.
Okay, just maybe turning to M&A, Alan, you've done a lot of small deals since 2015, I think 30 plus, maybe 35. Have you got enough out of those deals since you've done them? And maybe can I put you on the spot and ask you which are the two best ones that you've done, and maybe two that have done perhaps less well than what you thought?
Yeah, so if we compare, so first, trust us, we're responsible managers of capital, so we always have a good business case. And if we look at the performance of our acquisitions over the last few years, we do see a normal distribution around the business case. A couple that have done very well is, our prestige business. We have made very good progress on putting together this very carefully selected set of brands. I think we have now got the best performing luxury beauty business in the market at the moment, and we're emboldened to go further on that. Also, brands that we just fully smash into Unilever, like Koala in Latin America, do very well. And as I already said, Horlicks will do well. Let me be candid on the other side of the spectrum. I think we've struggled more when we've moved beyond our core expertise. So, Blue Air has been difficult, compounded by improvements that the Chinese government made to air quality in our core cities there. And Dollar Shave Club is also off the acquisition business case. Though that was also part of learning about direct consumer business models, and we sure have learned a lot there, and have some very promising projects that we are working on, and some others that we've stopped as a direct consequence of our Dollar Shave Club learnings. There you go, straightforward answer.
Yeah, it was, thank you. Just moving to the Sustainable Living Plan, I think 2020 is 10 years since that plan was put into practice. I mean, I think it's fair to say from my point of view, you were ahead of your time, or certainly Paul was when he brought it in. How do you maintain that leadership, especially in a kind of post-COVID world where aspirations and views are rapidly changing?
I'm glad we're touching on this, Warren, because I think there's two things that differentiate Unilever, and you have to decide whether you like it or not. One is our EM's exposure, and the second is our deep commitment and know-how on sustainable business. Our vision is to continue to be the global leader in sustainable business. We believe that will serve all stakeholders well, not least of which is because of the growing challenges that the world faces, social crises and environmental crises. They're becoming more pressing. It's a 100-year tradition in the company, and Paul did a brilliant job codifying it as the USLP 10 years ago. As you know, we've integrated our business strategy and our sustainability strategy in this thing we call our compass. We'll share more about that towards the end of this year, beginning of next year. One goal of that is to make sure that sustainability shows up more in our brands. We do believe strongly that brands with purpose grow faster. We know that purpose can be a real point of differentiation for brands, but it has to come on top of superior product quality, getting the pricing right, etc. And we think we've got a unique viewpoint and know-how on the blend of what your brands say and what they actually do. And then lastly, I'd just say we made some very recent announcements, a big climate and nature commitment in June. And just this week, an announcement that we were going to, by 2030, replace all the carbon that comes from fossil fuels in our home care portfolio with carbon sourced from other more renewable places. So according to GlobeScan, we are by far the global market leader in responsible business. We think it gives us increasing competitive advantage over time, and you can watch our actions. We're very busy in this space.
Okay. And Tony, I've got to ask you about unification. And we've got two important votes coming up. It's a seminal moment in Unilever's history, something you've tried for a few times. Can I just ask you and get your take on this Dutch Green Party proposal that you yourself have said could scupper unification and result in a big tax bill? Could you elaborate maybe on your options in the event of some kind of parliamentary delay? Is it binary, or how are you thinking about it internally?
Yeah, well, I should say that the board is absolutely committed to seeing through this unification proposal. Everybody agrees it's in the best interest of Unilever, and we're expecting strong shareholder support. Of course, we're monitoring the situation. This private members bill is still in its infancy, and we're not clear whether it'll even make it to Parliament. There's lots of unknowns. We believe our legal advice is that this bill would be in breach of EU law and definitely in breach of the current UK-Dutch tax treaty. We'll keep shareholders appraised, but I think we stand by our position, which is we're not going to speculate on all the many paths this could take. But if there's a high probability that exit would be associated with an 11 billion euro tax bill, obviously that wouldn't be in shareholders' interests. But personally, I think logic and common sense will prevail.
And assuming the shareholder vote goes well for you, just looking forward, Alan, what happens next? I mean, it seems like maybe internally there's a bit of a debate about scale versus focus. Correct me if I'm wrong. There's been a lot of talk out there around, bolder acquisitions. I think you yourself have said at the Q2 stage, there's maybe nothing imminent in the short term on the radar, but there could be in the medium term. And then, demerger, I guess you're always looking at valuation relative to your international peers. How do you kind of weigh up the options available to you in the event that unification does happen?
I think the first thing I want to say is that 99.99% of the person hours in Unilever go on maximizing the potential of the portfolio that we have today. And that is actually a pathway to increasing the valuation of the company, much easier and more value creating than sort of enormous churning of the portfolio. Nevertheless, we do want to unify the company to put ourselves on an equal footing when it comes to portfolio evolution. We've said we want to accelerate the pace of moving into higher growth categories and moving out of lower growth categories. And tea is a good example of that, frankly. The strategic review of tea has identified that a demerger or an IPO is an attractive possible option. One of those not available in our current legal structure, at least not practically available. The day when I stopped saying we don't see anything imminent on transformational acquisition, I think is when you should start listening carefully.
Yeah.
But all I can say for now is that, we're not preoccupied. Actually, maybe I'll put it this way, which is I don't feel pressure to move too quickly on transformational deals, because I think there's still a lot of trapped potential in the lovely business that we've got today.
And Alan, time's almost beaten us, but I have got one more for you, and it's a kind of a follow-up on portfolio. I mean, having been a Unilever watcher for some time, I do look at the portfolio quite carefully, and there's a number of areas where it looks to me you could do more. One would be US home care, where you were out of the market and then you've come back in with Seventh Generation and the laundress, and they've done really exceptionally well for you. The second is China cosmetics, where you yourself said you've been lobbying for a decade to get the rules changed around animal testing. What does that mean now that there's a more of a level playing field? And the third area is around Ollie Nutrition. I mean, I think I'm right in saying that's your first step into wellness, or not wellness, but to consumer health. Could you talk a little bit about your vision around each of those three opportunities in brief? What the attractiveness is, how quickly can you scale up those opportunities?
So those are astute observations. We end up in a similar place, but through slightly different lenses. Okay. We've been very clear on where we want to step it up. The first is skincare, including but not limited to Asian skincare.
Yeah.
The second is to take our luxury beauty business, the prestige division, to something that has scale that matters to Unilever. China is specifically an opportunity where we've worked with the authorities there for years now to demonstrate that you don't need to do animal testing to prove the safety and efficacy of the products. They've finally listened. And then the third is health and well-being, where it's kind of where prestige was 4 years ago. It's a twinkle in our eye. We acquired Ollie. It's going very well. We've just announced another acquisition, actually. And in fact, I should have maybe mentioned wellness as a space where we're ahead of business case. So if you take skincare, luxury beauty, and health and well-being, you'll be for sure watching places where we'll be investing for growth. On US home care, we can get extremely rapid growth there from particularly Seventh Generation, which we will also roll out to other markets. But I think we'll be cautious about entering some mass market head-to-head battle in home care in the US.
Listen, with that, Alan, I think we're going to have to cut it there. It's been a great conversation. Thank you for taking your time to present to us. And I hope to see you in person in Boston in 2021. Thanks again for your time.
You bet. Thanks, Warren. It's been a pleasure. See you soon.
Take care. Bye-bye.